Okay, I think everybody who is waiting is now in the seminar, webinar even. So we'll kick off. My name's Lizzie Lloyd, for those that don't know me, and I'm here with my colleague and fellow medical partner from Larkin-Gowan, Andrew Burwood. So we're going to be presenting this webinar tonight. I would ask that you put questions in the chat box as you go along. Get the most out of this webinar that you can. They are anonymous, so we won't name and shame you on any questions. So this is our series of webinars, and we're on the third one, which is in relation to tax charges. So our aim with these webinars has been to go right back to basics in the first two and set how your pension scheme is put together, different for GPs as to hospital doctors. And then we're now coming on to the pension tax charges that apply to your pensions. And this one tonight is for GP practitioners. The one next week is for hospital doctors. Doesn't matter if you're a hospital doctor that's here, just that the calculation slightly changes on some of the tax charges. But if you're happy to sit through more than one for GPs and hospital doctors, you'll have a great understanding by the time you've got through them all. And they will be available afterwards for you to review or go back and look at any that you've missed. So I think Andrew's going to kick off with the annual allowance pension tax charge.
Thank you, Lizzie, and hello, everybody. So just a recap of when annual allowance needs to be assessed and when it is applied. So briefly, the annual allowance is the amount that you can save into your pension pot in a tax year before you have to pay tax. Up until 5th of April 2023, there was a limit of £40,000 per tax year, and you'll see it says there potentially. It's potentially because you may or may not be affected by something called tapering, which Lizzie will cover in a few slides' time. After the budget statement that took place earlier on in the year, it was confirmed that the annual allowance would be increasing from £40,000 up to £60,000 with effect from 6th of April 2023. So potentially some very good news. Now, for those of you who are members of the NHS pension scheme, which I hope is everybody in attendance this evening, the actual allowance is not measured against the actual pension contributions that you pay. It's actually measured against the growth in your annual pension. When you consider that annual allowance that you are entitled to, you have to consider the amount that you pay into a defined contribution scheme. So in other words, any private pensions you may have, if you have any employment roles where the employer pays contributions as well, which is outside of the NHS pension scheme, you have to consider those. For the NHS pension scheme, it's the increase in pension benefits, as I previously mentioned. And then if you are subject to a tax charge, so in other words, the growth in your pension or the personal pension contributions that you've paid added together, if they exceed the annual allowance to which you are entitled to, then that is taxable at your marginal rate. So either 20%, 40% or 45%, depending on what your level of taxable income is. Bear in mind as well that the budget also brought in a change to the 45% tax band in that it now applies where taxable income is £125,140 or more. Previously, the 45% tax band did not come in until your earnings or your taxable income went above £150,000. One other positive is that you can bring forward any unused allowances from the previous 3 years to offset against any excess growth in the current year. Okay, so let's have a look at the NHS pension scheme. The NHS pension scheme is a defined benefit scheme, and therefore you must consider the increase in pension benefits in any given year. You'll note that it says ignore contributions paid. The physical pension contributions that you pay in any given tax year, they are deducted from your taxable income and you get tax relief on those at your marginal rate. So if you are a 45% taxpayer, the contributions that you pay, you'll get 45% tax relief on those automatically, which is very positive. When looking at the NHS pension scheme, the growth is calculated by taking the increase in pension benefits, you multiply those by 16, and you also have to factor in any increase in the lump sum. So if we have any 1995 members in attendance this evening, the 1995 pension scheme comes with an automatic lump sum entitlement of 3 times the annual pension. For those who are in the 2008 or 2015 scheme, there's no automatic lump sum entitlement. So I'm just going to take you to the next slide, and I'll come back to this one because I've got some numbers just to explain that a bit further for you. So as mentioned, the growth, which is known as the pension input, is based upon the increase in pension benefits multiplied by 16 plus the increase in lump sum. Now, if you are a practitioner, the calculation of pensionable profits is quite complex, but as a general rule of thumb, if you are a typical partner in a typical practice, your pensionable pay is roughly 85% of your overall profit share. Just before we get to the numbers, I've listed out the accrual rates under each scheme, which we have covered previously, but just to give a bit more detail this evening, the 1995 scheme, the pension that you accrue each and every year is 1.4% of your pensionable income. If you remember the 2008 scheme, it's 1.87%. And if you remember the 2015 scheme, it's 1/54th, which equates to 1.85%. So let's look at a scenario where a partner has a profit share of £150,000 for the year, and let's assume that 85% of that is pensionable. That would give you pensionable pay of £127,500. So in other words, we then move on to what your pension will be and what the growth will be in each of those schemes. So in the 1995 scheme, it's 1.4% of that pensionable pay, so £127,500 multiplied by 1.4% gives you an annual pension of £1,785. The growth in the 1995 scheme, you have to multiply by 19 because it's 16, you'll see at the top of the slide, increase in pension benefits multiplied by 16. The standard lump sum entitlement is 3 times that pension, so the factor that you apply is 19. So that would give you growth in that particular year of just under £34,000. For the 2008 and 2015 schemes, it's multiplied by 1.87 or 1/54th, as noted. No lump sum entitlement, so it's multiplied by 16 only. The growth in 2008 scheme, 38,000. Growth in 2015 scheme, just under 38,000. So that's how the calculations are arrived at for the pension growth in any given year. The only other thing you have to factor in is the uplift applied to your pension pot brought forward, which will be 1.5% moving forward. Again, Lizzie will cover off the changes what have taken place recently. So this dynamisation disconnect you may have heard, or inflation disconnect you may have heard about previously, that's not going to be an issue going forward. So I'm now going to hand over to Lizzie. Actually, I'll just go back that slide again. Yes, so we've covered off how that growth pension input is being calculated. It applies to 95, 2008 and 2015, as we've mentioned. Now, in terms of how you establish that annual allowance, NHS pensions will write to any members who have growth in any given tax year above the standard £40,000 or £60,000 allowance, but they will not know if any individuals are subject to tapering. So at this point, I will hand over to Lizzie, who's going to cover off the tapering of the annual allowance. Lizzie, over to you.
Thanks, Andrew. So I think, as we can see, you need to be some sort of Carol Vorderman to be able to work out the annual allowance tax charge, because you've got to know which scheme you're in, and you're going to probably be in more than one scheme, so you're going to have to do the calculation more than once. You're going to have to work out if it's 1/54th or 1.4%. You're going to then have to multiply it by 16 or 19, and then you're going to have to factor in the inflationary or the dynamisation on your pension pot. And it's been that dynamisation that, particularly in the last couple of years, has been very problematic for the annual allowance pension tax charge, because it grows your pension by more than the allowed amount according to HMRC. So when inflation is rising, it's generally been a bit of a problem. But as Andrew said, we're going to come back to that later. So yeah, it is complicated, and as Andrew reiterated there, you can't just look at your pension contributions. A lot of people go, well, my pension contributions are below 40,000, so I haven't got to worry about it. But that's not correct. The pension contributions, because it's a defined benefit scheme, are just what the scheme has determined you will pay for that pension. And that's why those percentage contributions sometimes change, because the scheme is looking at making sure they always remain in the black, i.e. the contributions it gets in from its members are sufficient to pay out the benefits to retires members. So there's a further sting in the tail with the tapering of the annual allowance. So if, as Andrew said, you've got your 40,000 or going forward, but when I say going forward, it's only for this tax year from 2023. So we've still got 22-23 when we've only got a 40,000 annual allowance. That 40,000 or 60,000 annual allowance may be reduced down if you're deemed to be a higher earner. And when they first brought in this concept of higher earning, it was anybody with threshold income above 110,000, but it's now above 200,000. So if you trip over that by £1, it's kind of all or nothing, although then there's a tapering. You could lose some of this 40 or 60,000. So although your annual allowance pension saving that Andrew's just worked out might be 38 grand, you may only be entitled to a 20 grand tapered annual allowance. So you're 18,000 in excess. And if you've got no unused relief to bring forward, then that 18,000 is subject to tax at your highest marginal rate of tax, income tax, which going forward is likely to be 45% because that tax rate kicks in now from 125 grand. So I'm not going to go through how the tapering works because it's fairly complicated again, because you've got to add on the pension figure you worked out above in the previous examples to your taxable income, and then you've got to taper. Anyway, the main point to take away is this tapering is still going to continue despite the changes they've made to increase the annual allowance from 40 to 60,000. The tapering still kicks in if your taxable income is above 200 grand. And by taxable income, we mean everything that goes on your tax return. So not just the bit of income that's pensionable, i.e. the practice profits, it's everything. So if you've got overseas income, if you've got rental income, if you've got dividends, these are all savings income. Even if you've got, because you might know that some dividend income is tax-free, but it still counts as your taxable income when looking at this 200,000. So if you are close to the 200,000 going forward, it would still be a great idea to try and keep yourself under that 200,000 if you can. Some practical things you might be able to do is, do you need that income on your tax return? Now, obviously, you don't have a choice whether you put it on, but if you jointly own a property with your spouse, you may share the income 50-50. Now, you probably have to do it that way if you own it as joint tenants, but you could own it in a different way, which does involve some solicitors' fees, but split the joint tenancy and who owns that property, or transfer it completely to your spouse if they're not affected by these tax rates, so that that income pulls out of your tax return and is taxed on somebody else. If you're thinking of taking dividends from a company, just make sure that's not going to trip you over. If you've got some overseas income that you don't bring back to the UK, it may be that you don't have to include that on your tax return. It's quite difficult to plan what your profit is going to be because you don't know what your profit is going to be necessarily exactly in the year until after the tax year. But if you think you're going to be close to the 200,000, you may bring forward some expenditure to reduce your taxable income below the 200,000. So bring it into an earlier accounts year, i.e. rather than buying those new pieces of equipment in April, if you've got a March accounting year end, you might buy them at the end of March and then you get the tax relief a year earlier and may get below the 200,000. So just flicking to this next slide, I think I've pretty much covered this, but yeah, for the tax year that you've still got tax returns to do, so that ends on the 5th of April 2023, you've still got this 40,000 annual allowance. Now it says adjusted income below 240, but ignore that 240. The starting point is your taxable income above 200,000? If it is, then we have to look at your adjusted income to see if you're then tapered and you lose some of the 40,000. and that 40,000 can be reduced to a minimum of just £4,000. And going forward, you've got 60,000 annual allowance. So although the taxable income still starts at 200,000, so that's still your aim. Try not to earn too much. You can have adjusted income of 260,000, and then the tapering is down to 10,000. So tapering is still a thing, but you're not going to be as tapered as much because of the 60,000 rather than the 40,000, I guess is the point from that slide. So you've worked out all your pensions, you've looked at whether you're tapered. What happens if you actually then still have a tax charge? So let me transfer you back to Andrew and he will tell you all about that.
Thanks, Lizzie. Just before we go on to that next slide, we've got a question from Sunda. Good evening, Sunda. The question is, what is the difference between taxable income and pensionable income? So I will answer that one for you, Sunda. Pensionable income is what your profit share is. Oops, sorry, my sharing my webcam. Yes, I can share my webcam, you lucky, lucky people. Pensionable has completely thrown me now. Pensionable income comes from effectively your share of partnership profits, and your annual superannuation certificate calculates how much of that profit share is subject to pension contributions. Taxable income is a completely different calculation. It's taking all of your income from all sources, so partnership, if you had any buy-to-let properties, dividend income, any source of income that get reported on your tax return, that's the definition of taxable income. So I hope that answers the question for you.
I've just mentioned there, Andrew, charitable payments made under gift aid do not reduce your taxable threshold income for the purposes of this 200,000. So that's not a clever idea we can do, I think is all I need to say on that.
Yeah, no, that's a good point. So any payments made under gift aid, all they do is extend your 20% basic rate tax band. They don't change your taxable income as such. Okay, let's move on to the next slide and talk to you about what happens if you have excess growth. So we're in a scenario here whereby whichever, have I gone too far? No, I have not gone too far. Yes, this is the slide. So this is a situation where the growth in your pension, together with any private pension contributions you may have made, exceeds the annual allowance which you are entitled to. So either 60,000, 40,000, or something less than those if you are subject to tapering. So the situation is that if you've got excess growth in the year under review and you have no unused allowances brought forward from the 3 years before to offset against that growth, then you have to report that pension savings charge on your tax return. And because it's self-assessment, it's your responsibility to make sure that your tax return is complete and correct, and therefore you can't just ignore whether an annual allowance charge applies or not. As Lizzie mentioned, any tax arising on an annual allowance charge is payable at your highest marginal rate. And you then have a choice. You can either pay that tax personally, so it will increase the payments that you make through self-assessment, or you can ask NHS Pensions to make what's known as a scheme pays election, where NHS Pensions pays that charge for you on your behalf. Do note that if you want NHS Pensions to pay that tax charge for you, they will only pay the tax charge on the growth relating to the NHS pension scheme. It won't cover any growth caused by private pension contributions. You'll note there it also mentions the fact that it does affect payments on account as well. So on your tax return, you have to calculate your tax liability, including the tax arising on excess pension growth. You then compare that total liability and deduct from that the payments on account that you make in the January and July payments through normal self-assessment. The balance of tax is then paid in the following January, and then the cycle starts all over again in terms of payments on account for the following year. So if you pay that annual allowance charge personally, effectively the tax that you have to pay in January is 1.5 times that total tax bill arising on the excess pension growth, because tax payments on account are based upon 50% of the previous year's total liability. And then your payment that you make in July, you're paying half again of that annual allowance charge that you need to make. Whereas if you go for a scheme pays election, you are just paying the tax on your earnings as normal. There's no tax payable on the tax arising on the pension growth in excess of the annual allowance that you are entitled to. However, it doesn't come without cost, as you would expect. So if you make a scheme pays election, interest will be charged and it's rolled up on a cumulative basis. The rate is 2.4% plus inflation. You don't pay that annually, but what happens is effectively NHS pensions, the tax that they've paid on your behalf to cover the annual allowance charge, it's effectively treated as a loan to you. So NHS pensions will recover that from you via a deduction in your, a reduction in your pension benefits when you come to take those on retirement. So scheme pays can work in terms of managing cash flow whilst you're an active member of the pension scheme if you have annual allowance charges. But as part of planning for your retirement, you need to be aware of the impact of these scheme pays elections, what they will have on your pension benefits on retirement. So we can do the numbers for you, but we cannot give you the appropriate advice in terms of how you settle that tax, what pension you need to get in retirement, all of those things. If you want advice, you need to speak to an independent financial advisor. And if you need somebody to talk to, we have people that we can recommend to you. If you wanted to make a scheme pays election, then the deadline for that scheme pays election is the 31st of July following the tax return submission deadline. So for the 22-23 tax year that's just finished, your tax return has to be submitted by 31st of January 2024. The scheme pays election will have to be completed and submitted by 31st of July 2024. The last point is that scheme pays can be mandatory or voluntary. It's worth noting that this can have an impact on who is liable for any interest charged by HMRC. This payment is often made by the pension scheme after the normal payment deadline set by HMRC. So if you made a scheme pays election, NHS pensions will pay HMRC on a quarterly basis. If the scheme pays election is not done ahead of the filing deadline and when the tax payment is due, then HMRC will charge interest for that effective underpayment of tax. That's something to bear in mind as well. So that covers what happens if you have excess growth. The next slide is going to be covered off by Lizzie, which is how will I know what my pension input is? Lizzie, over to you. Oh, sorry, Lizzie, you're on mute, but before we go, we've got another question from Sundar. He's on fire this evening. Would McCloud judgment revisions be of any help once people retire? We'll come on to McCloud, Sundar, in due course. So I'll hand back to Lizzie as promised on pension input, and I'll make myself silent as well.
And I've taken myself off mute, which is always helpful. So yeah, if you've got a pension excess, you're not going to know about it at the time you need to complete your tax return. So, for example, for the tax year ended 31st of March or 5th of April 2023, you're not going to submit your pension certificate, which forms pretty much the basis of the annual allowance tax charge, until February 2024. You're going to submit that to PCSE. They're going to process it. They're going to send the data to NHS Pensions, who are then going to do a refresh in August 2024. That will be the earliest and highly unlikely that you would actually even get the figures from the Pensions Agency at that date. Because of the delays with processing with PCSE, it's probably more often than not we see them start coming out in October, or sometimes even later, particularly if there's been opting in and opting out, and the records haven't been refreshed. So although NHS Pensions will have committed to write to people if the pension growth is above the standard allowance in one or more than one scheme, I don't think that can be relied upon, because they might not get the data for a long while, because your pension record may not be updated, because you might have missed a pension certificate 3 years ago when you were a salaried GP or something. And also, I still don't think it can be relied upon because you've got more than one scheme. Also, if you're tapered for annual allowance, they're only going to tell people if they're above the standard annual allowance. So if tapering applies, you're going to have to request the information yourself. So you're not going to be able to get the information for your tax return. And therefore, as you've got to complete the tax return on a just basis, you really need to be working with an accountant who can try and work out these numbers for you. yeah, I guess technically you could leave it off and put a note to HMRC that you haven't got the figures yet. But all that's going to mean is when you do get the figures 2 years later, there's going to be quite a lot of interest accrued. You might have missed the scheme pay election deadline. So it's not really a route that we would suggest that people go forward with. So when they do send you a pension savings statement, it looks like this next slide, although this is quite an old one. I think Andrew's just going to move us forward. Well, you may not be able to see this next slide because it's very tiny, but basically it will come in a brown envelope to you, and it will show the tax year in question and the 3 previous tax years, what the growth for annual allowance purposes, which might be called pension input, it might be called pension growth, pension savings, they all kind of mean the same thing, is for each tax year. So you can look at your unused relief from the previous 3 years. I would say that quite a lot of these are not right when they come out, particularly if you've opted out of the scheme, because PCSE and NHS pensions might have closed your pension record on an estimate and not updated it since you've submitted a pension certificate. It may not take into account other positions that you have. There may be missed certificates, so it won't be up to date. So we would always recommend that your pension is reviewed to make sure the basics is right. Then if somebody has estimated the annual allowance, you can see whether it's wrong. I mean, we've had some quite large figures come through on pension savings statements, which we know are just ridiculous. If anybody had looked at them, they would know that they were wrong. But some people may just put those on their tax return, assuming the pensions agency figures are correct. Now, on those growth figures, they go up and down. Now, that doesn't mean your pension's gone up and down, and it doesn't mean the growth has necessarily changed. It's because how the inflation works in the calculation. So people will say to me, but nothing's changed. Why is my growth this year only 20,000 when it was 80,000? Where's my pension gone? It doesn't really relate anything to do with that. It's just the inflation having an impact. So just make sure you're getting those figures checked. There would be a second page to this pension savings statement, or a second blob of figures, which show closing pension values, which can be quite useful if you know how to interpret them, in estimating your pension benefits. You can also request now, which is what we do for clients, which is quite useful, a service extract, and that will give pension input figures going all the way back. It will also give a service extract showing pensionable income and where you've worked, so there's a double check that you can do there, and it will show them on one page in each scheme, because probably most of the people on this call are going to have pension benefits in more than one scheme, the 2015 scheme and a legacy scheme, maybe the 1995 scheme. So you would then need more than one of these bits of paper, because you would get one of them for the legacy scheme and one for the 2015 scheme. So yeah, I think that kind of covers off where you'll get the figures from, or eventually, and what they might look at. But whenever you get any letters from the pensions agency, I'd urge them always to send them to us, to your accountant, to check and make sure that there's no action that needs to be taken. So what sort of person is more likely to be caught by the annual allowance tax charge now, do you think, Andrew? If you can show your face again.
Very nicely worded, Lizzie. But just before we go on to that next slide, I have gone on to the slide, but the point that Lizzie makes about obtaining a service extract from NHS pensions, that is a real top tip, not only to help you understand and us to understand where you are in that pension cycle, but also it gives you an opportunity to do an audit of your pension to make sure that all of the contributions that you've paid over the years are reflected in your pensionable pay, and therefore you will receive the appropriate pension benefits on retirement. And you would be amazed at how often, sharing my webcam again, you'd be amazed how often that things are missed, service is not up to date, so you've paid the contributions, don't get the pension benefit. That's just not acceptable. So having a personal audit of that service extract is really, really sensible and appropriate to do. So Lizzie set me up nicely with when can issues arise. So let's go through them. So the first one is increasing profits. So if pensionable pay is increasing, pension growth will also increase. So I gave you the example previously of pensionable pay based upon practice profitability for an individual partner of 150,000. Let's say that the practice had a bumper year profitability wise, whether it's, well, if you consider a couple of years ago, COVID vaccinations really saw an improvement in practice profitability across the board. Let's say that pensionable pay became £200,000 in that particular period. In the 1995 scheme, pension 1.4%, multiplied by that by 19, because that's the factor you have to apply, that would give you growth in that year of 53,200. The double whammy is that if your profit share has gone up, you're likely to be subject to that tapering of the annual allowance. So you can imagine growth of 53,200, compare that to the annual allowance that you are entitled to, that's where the problem arises. So hopefully I've explained that in a bit more detail so it becomes a bit more clear. Periods of increasing inflation, I touched on this previously. I'm going to skip it again now because again, Lizzie will cover that on a subsequent slide. If you have outside earnings, so earnings outside of the partnership in addition to your partnership earnings, if they push your taxable income above £200,000, then again, you've got the tapered allowance as what we've said before. If you are one of the few GPs remaining that still has an added year's contract or are purchasing additional pension, it's probably fairly obvious that that's going to increase your pension benefits and therefore the growth in your annual pension and therefore the growth for annual allowance purposes. So whilst the added year's contract is very worthwhile in terms of increasing benefits in the 1995 scheme that you can access at age 60 or before if you decide to take it earlier, it's then subject to abatement, which is roughly 5% reduction for every year prior to age 60 that you take it, it does have a big impact on the growth in your pension. So this is not any advice whatsoever to say if you've got an added year's contract, cancel it. Not saying that in the slightest because the benefits are significant, but just be aware of the implications that has as far as annual allowance is concerned. The other thing that I touched upon previously is if you make private pension contributions. So the annual allowance that you are entitled to, whether it's the full amount or a tapered amount, it is the growth in your pension, NHS pension, together with any private pension contributions that you may make or any contributions that you pay through an employment where your employer makes contributions as well. So all of those have to be taken into consideration when calculating whether or not there is growth in excess of the annual allowance that you are entitled to. So it's time for me to set Lizzie up now with the changes that were announced in the budget, which will be of particular interest to you all. So Lizzie.
Although, just going back to that slide, Andrew,
we can go back
because I didn't mention this earlier, and it's maybe a useful point if you think I can say it. But if you've got outside earnings that would tip you over the 200,000, you could consider forming a company to generate those earnings if you can. A company could deliver that income, because a company can shelter that money away from your personal tax computation, not if you need it to spend, and it doesn't necessarily save you income tax over the ownership of the company. It's like a deferral, but it could actually potentially save pension tax charge if you're tapered for annual allowance.
No, that's a really good point.
Yeah, the top tip.
Top tip. What about if somebody, we'll get into technicalities now, but what about if we had somebody who was a practitioner member of the pension scheme and they also had an officer post? Yeah,
you can, I believe, again, not being an IFA, you can opt out of one and not the other. So we're not talking about hospital doctors here tonight, which are more likely to be in officer schemes, but some practitioners do have officer earnings, so positions with the ICB, that kind of stuff. But that, again, you'd need to take financial advice before you opted out of any part of the pension scheme.
Yeah, and it's also worth discussing with the employer about the potential recycling of the employer superannuation contributions that they pay on your behalf if you did go down that route, because we are aware of some employers where somebody has opted out of the officer section of the pension scheme, they've been able to secure an uplift in their overall salary to reflect the fact that the employer is no longer having to pay those contributions. So again, we love a top tip. That's another top tip. Just before you go on to those changes, Lizzie, we've got another question from Sunda. Thank you, Sunda. If I read this out, Lizzie, could you answer it? So, how near retirement should people start thinking of reviewing their pension? I've got 7 years before I plan to take retirement. Should I be looking at this now or a year or two before retirement?
Now, so I gave a talk to GP trainees yesterday and I said, you've got to look, this was one of my top tips to them. You need to get access and look at it now, and you probably need to check it every year, every 2 years at least, because if there's missing parts to it, it's not necessarily easily to rectify that. You might have to go back and find pay slips from your loft. So it's better to start doing that now and get that all straight, and then just check it keeps up to date, particularly with the McCloud remedy, because if it's not right now and then it goes back into McCloud and then you get a whole lot of different annual allowance figures and then you rectify it, that whole thing's got to start again. So definitely look at it now. Is that the right answer, Andrew?
That is definitely the right answer.
You mentioned about increased earnings from practices in recent years because of COVID. Now, obviously, we don't know what's going to happen with practice income, but the uplifts are not huge for practice on their GMS contracts, and expenses are rising well above that. But PCN income, primary care network income, is where the new funding is going, and that is pensionable income. So that will form part of your pensionable pay calculations. Right, shall we go on?
Well, we're going to go off on a tangent now, but just to expand, you've started it now, so I'll have to finish it. PCN accounts are a massive subject. All I would say is that if you are a member of a PCN, make sure the accounts are prepared annually for your PCN. Your share of any profit is reflected in your own accounts annually, because if you have a situation where there's effectively a catch-up or profits are recognised in your own accounts based on payments made by the network to your own practice, that has the potential for huge spikes in income being reflected in the incorrect years. You've got to make sure that you are all over this and that your accounts are prepared correctly with the annual income that belongs to you from your network. Any queries on that, Lizzie and I will be very happy to talk to you about your networks and all of the issues arising for those, so do get in touch. But I think we've gone off on so many tangents, Lizzie, we ought to carry on with changes introduced, so here we go.
Well, as you can see, we do like anything medical finance, and I'm hoping everyone tonight watching is enjoying these tangents. Anyway, changes introduced. So Andrew's talked about the HMRC annual allowance changes, the increase from 40,000 to 60,000. So it gives you more scope to cover your growth. There was also some changes introduced by the NHS Pensions Agency. So the main one for this, well, the main point is the inflationary element. So when the annual allowance calculations are worked out, HMRC allows for any inflationary uplift, but they use the inflation figure from the year before the Pensions Agency do. So the Pensions Agency will uplift it, let's talk about 22-23, although this is the year it's changed. So in 22-23, under the previous NHS pension legislation, the CPI, the inflation factor, was 10.1%. So if you're a contributing member, you get that plus 1.5%. So your pension benefits would have gone up by 11.6%. So you can think, if you've been following the maths, oh, that multiplied by 16 or 19 is going to give a massive annual allowance figure. Now, as I said, HMRC allow your pension benefits to go up by inflation, but they reduce the inflation from the previous September, which was 3.1%. So there was a disconnect there. And therefore, when inflation was rising, you got very high annual allowance pension tax charges. And when it fell, you could have even had negative pension tax charges, which you can't do anything with. So this was a real problem, and one which has been concerning us for 22-23. Now, the dynamisation, this inflation plus 1.5%, was added by NHS pension on the 1st of April every year. So it just came into the tax year, which ended on the 5th of April. So the changes in the NHS pensions legislation is to push that back. So that gets applied on the 6th of April, which means in the 22-23 tax year, your pension benefits won't go up by 11.6% because they'll go up 11.6% the next year. Basically, they've just been shifted back 5 days. You haven't really lost anything overall. And then when they are applied in 23-24, they're going to be compared to the HMRC uplift that's allowed of 10.1%. So broadly going forward, the 1.5% growth on your existing pension pots is still going to count for annual allowance and could give some people a problem if they've got large pension pots. But that disconnect by the way the inflation was applied, which caused big pension charges in 21-22 because inflation had gone up from 0.5% to 3.1%, has now gone away. So that coupled, that's coming in for 22-23. Great news. 23-24, we've got the 60,000, the 40 to the 60,000. So we're not saying people are not going to be caught by these annual allowance tax charges going forward. There is still problems. We've still got the tapering at 200,000. We could still have people with high pension pots, as Andrew's just gone through, who could get caught by this. But potentially it's going to be a lower figure than it has been previously. Andrew explained how if you pay the pension tax charge, it also increases your payments on account. So if you had a pension tax charge that you paid, then that might be in your payments on account that you've got to pay at the end of July. Now, if you've got all your tax information, you're not waiting for sets of accounts, it may be that you could reduce that July tax payment because the annual allowance tax charge will be less if you can get your tax information in extremely soon. So that can be worked through. That is an option for people. So with these changes that are introduced, we have perhaps had more people opting back into the pension scheme where they had opted out previously to avoid the pension tax charge. But there's not a right answer to that. It depends on the person's particular circumstances. Because by opting back in, you potentially have got some rolled up 1.5% to account for. You may have some unused allowances from the previous 3 years. So you need to obviously speak to a financial advisor and have a look at the numbers about opting in and opting out. Oh, is it still me or is it you, Andrew? It's me. McCloud. Okay, so we had a question about McCloud. So the McCloud remedy, we have sort of covered off in the previous webinars very briefly. There was a podcast on it there. But where you have had annual allowance tax charges from 2015 to 2022, because you have been moved to the 2015 scheme, they are going to have to be all recalculated because of the McCloud remedy and those 7 years of pensionable pay going back into your legacy scheme. So it will mean that the numbers will be recalculated, the tax returns will be amended. If you've paid any annual allowance pension tax charge yourself, there will be an adjustment. If you've done a scheme pay election, there will be adjustment. Now, as we currently sit here, we don't really know how the admin of all of this is going to be sorted out. We know that HMRC are working on some sort of calculator, some sort of way to be able to do it automatically their side, but that still doesn't mean it doesn't need to be checked quite thoroughly. Because the accrual rate, the rate of growth in the in old legacy schemes, the 1995 scheme in particular, is lower than the 2015 scheme, it may be that actually the annual allowance tax charges that you've paid will reduce slightly. But it does really depend on everyone's individual circumstances and how their pension is put together. Hopefully that answers the question on McCloud as well. Oh, although maybe just coming back to that, will it help people who've already retired? Yes, those calculations will have to be done even if people have already drawn their pension benefits. So I would assume that they will start with the people who have recently retired first, because those are the ones that have got to be corrected first and then move their way through everybody else. Right, So, Andrew, I think we're just going to finish up with some lifetime allowance issues after talking about the annual allowance pension tax charge.
We are indeed. Okay, so we've bombarded you with annual allowance. We just need to have a brief look at lifetime allowance. So there are two tax issues that you need to consider throughout your career. And when it comes to drawing pension benefits, you've got the annual allowance, which is an annual consideration. And then you've got the lifetime allowance, which is considered when you come to take pension benefits on retirement. So the allowance itself, it looks at the total pension benefits that you have built up and determines whether or not a tax charge will apply. The value of all your pension benefits, and that's the capital value. And in this scenario, you'll see on the next line, it's the annual pension multiplied by 20 as opposed to 16, which you look at for annual allowance purposes. Multiplied by 20 plus lump sum if you're a 1995 pension scheme member. You have to look at all of the capital value, and then if there is an excess above the lifetime allowance, which is in place at that particular point in time, there's a tax charge when you take your benefits. I should mention with the lump sum, if you are a member of the 2008 or 2015 scheme, we said previously there's no automatic entitlement to a lump sum, but what you can do is exchange some of your pension for a lump sum, and the exchange rate is £12 of pension for £1 of lump sum. So if you did decide to take a lump sum from your pension, then the calculation is, of course, the annual pension plus the lump sum added to that as well. If you are subject to a lifetime charge, the tax is taken by your scheme provider and paid over to HMRC before benefits are paid to you. Just to give you some context of the previous lifetime allowance and what that would mean in terms of the pension that you could accumulate. So you'll see there that it says prior to April 2023, the lifetime allowance was 1,073,100. If you were a member of the 1995 pension scheme and you took the standard tax-free cash on retirement from that pension scheme, an annual pension in excess of £47,000 would tip you over that lifetime allowance. If you're a member of the 2008 or 2015 scheme, then the annual pension, anything above £54,000 would tip you over that lifetime allowance. So that just gives you some numbers to consider. Since April 2023, the lifetime allowance has actually been scrapped. So now you can build up as big a pension pot as you like without facing any tax charges. However, there's probably a health warning with that, or two health warnings. The first one is to build up a pension pot, you've obviously got to be an active member of the scheme. So yes, you could have your NHS pension, you could be paying into a private pension just to maximise the pension that you get on retirement, but you've got to consider annual allowance charges. So the question is, do I want that bigger pot on retirement, or do I want to minimise my tax charges? Am I happy with the pension provision that I am accumulating at this particular point in time? So that's the starting point. The other point to note is that this was announced by the Conservative government. The likelihood is that if there is a change of government in the coming months, if Labour do get into power, I suspect that they will reverse the decision to scrap the lifetime allowance. They've said publicly that they don't agree with it. If that's the case, then we could have a lifetime allowance back in place again. It could even be a lower value than what it was previously. So this could be a year where you make maximum benefit from that. It depends on personal circumstances. Clearly, cost of living now is higher than it's ever been. We've got huge challenges. You have to consider this on an individual basis. There's not a one-size-fits-all set of advice that can be given. The other point to note with lifetime allowance is that when it comes to drawing your pension benefits, this is not on the slide, but the maximum tax-free cash that you can take is 25% of the capital value of your pension. However, the cap has now been put in. It's 25% of the previous lifetime allowance, which is 1,073,100. So the maximum tax-free cash you can take in the current year, if you're thinking about drawing pension benefits, is £268,275. I think that is everything on lifetime allowance. So we have got another slide, which is on what you should be doing now. So, as previously mentioned, we would always encourage you to review your pension benefits on a regular basis to make sure they are accurate. Inaccuracies can lead to incorrect pension benefits and incorrect pension growth calculations. And of course, you don't want to be paying pension contributions for which you get no benefit from on retirement. Accessing your total reward statement will provide an estimate of your annual pension in terms of income and lump sum entitlement. One point to note is that the current gov.uk verify system, which is used to access total reward statements, was closed on the 30th of March of this year, and we are awaiting a new digital service to replace it. So it is a case of watch this space as far as access to total reward statements is concerned. However, you can contact NHS Pensions and they will provide you with a copy of that within 40 working days. The contact details are shown on that slide. Statements are updated annually and it's usually in August. However, the point to note is that if information isn't available to NHS Pensions to update them at this point, an updated statement may be available in December. So we are at the mercy of PCSE on all of this. Your superannuation certificate has a filing deadline of the 28th of February, being 1 month after the filing deadline of your tax return. In theory, if you submit it on time and don't miss the deadline, PCSE should process it on time, but unfortunately we're dealing with PCSE and I hope no one from PCSE is in the room, but it is a considerable challenge. The number of conversations we have with PCSE over missing records, unupdated records, incorrect superannuation collected, the list goes on. So yes, it should be available in August, but we are at the mercy of PCSE. And of course, if you are concerned you have a pensions tax charge or you've received that brown envelope through the letterbox, as Lizzie mentioned, please do get in touch with us or your own accountant. If your own accountant is not familiar with the intricacies of the NHS pension scheme, then it would make sense to speak to somebody who does know. So that's a quick plug for us. The other thing which is not on that slide is you do need to consider the cost of membership of being an active member versus the benefits that you get from the NHS pension scheme. Again, we cannot advise on those. We've talked about the pension that accrues under the various schemes, so you've got that information to hand. The contributions that you pay as a practitioner, you pay both employee and employer contributions. The employer contribution rate is 14.38%. The employee rate is based upon tiered levels of earnings. The highest contribution rate for employees now was 14.5%. It came down to 13.5% from October last year. It's going to come down again to 12.5%, likely to be October of this year, but date still to be confirmed. So you can work out the contributions that are payable on pensionable income. You can then factor in the tax relief that you get at your marginal rate for those contributions that you pay. It's then comparing what you're paying against the benefit you get. But also bear in mind that the pension scheme not only buys you a significant pension on retirement, but you've got additional benefits such as death in service, critical illness, spousal and family pensions as well. The other point to take away from this evening is when you are looking at the cost of everything, do consider any private insurance policies that you have in place as well, because you may be overinsured as a consequence of the benefits that you get from an NHS pension scheme. So that's my last top tip for this evening. We do have time. We've got 5 minutes if anyone has any further questions. So please do ask if you do have any. Lizzie, anything you'd like to add at this stage?
Well, I just think it's quite nice to give a more upbeat pension presentation than we've been giving over the last 5 years. There is actually some good news, although, you know, there's still a lot of admin involved in your pensions. As Andrew said, PCSE are not very good at sometimes processing, updating NHS pensions records, and that all has to be really looked at carefully, and logs will have to be kept if you've got McCloud remedy as well to factor into that as well. There is a question which is death in service benefit and how it's calculated. I think I know the answer. Shall I have a go?
Have a go, Lizzie. It's not the easiest one to answer.
There is quite a lot of information on the Pensions Agency website, so I verify what I'm about to say on there. But if you are a contributing member to the NHS pension scheme, the death in service benefit is 2 times your pensionable pay. So in the example that Andrew gave right at the beginning, it's that 150,000, so your practice income, about 85% of that. That's that's not your necessary figure, but it's what goes on your pension certificate. Whereas if you are a deferred member, so that means someone who has opted out of the pension scheme, it is 2 times your pension, which will be lower. Your pension may be, I don't know, 40,000 or something, so it's going to be lower. So as Andrew said, that needs to be factored in with any decisions you make in your pensions. Speak to an IFA to see if you can replace, you know, those benefits if you need them. But there are other benefits to the scheme, dependence benefits, I think, as well. And obviously, if you're drawing your pension, there's no death in service benefit then, but then there is obviously spousal pensions. But this is slightly off my area of expertise, I have to say.
Sundar's asked a further question, Lizzie. I feel like can I just clarify that I haven't paid Sundar to ask all the questions this evening?
Is it the pension certificate the year one passes away? Oh, that's a great question, and I feel like I should know the answer to that. I think they look at the last couple of years. If I can't answer that here exactly, but I think I have got the answer somewhere in my research pile. So if I can try and find it, and I can Andrew can maybe email you what we think the answer is.
That's a good plan.
I mean, obviously don't plan to pass away, I think would be the best advice that we can give at the end of this presentation. Okay.
So contact details are on screen, but I'm afraid I do have to flash up our usual disclaimer slide. This is a presentation to help you with your understanding of the NHS pension, the tax implications in particular. It's not specific advice to your own individual circumstances. So if you do require advice or help, please do get in touch and we'd be delighted to help you.
Thank you and have a good evening, everyone.
Thanks, everybody. See you soon.